Hi guys, in this video we are going to talk about a very burning topic for the past few days, that is LTCG tax on the shares under the budget of 2018. So let's first look at the relevance of this topic with respect to our examination. So for NABARD this topic can be asked under the current economic and social issues, and in RBI it can be asked in FM portion under primary and secondary markets, the union budget and current economic and social issues. So in the budget of 2018, Finance Minister has proposed to reintroduce this LTCG tax on the gains above rupees 1 lakh. So government has brought back this tax on equity and mutual fund investments if the amount of gains are exceeding rupees 1 lakh. So these are the kinds of headlines which you all would have read about in the past few days in all the major newspapers. So in this video we are going to decode this amendment and try to understand it in a very simple way relevant for our examination. So let's start by looking at what is LTCG. So this is the most basic part. So LTCG stands for long-term capital gains. So long-term we understand that it is for a longer period. What is capital gains? Now capital gain is increase in the value of a capital asset, which can be investment or real estate or a property, which gives it a higher worth than the purchase price. So if you bought a property worth rupees 1 lakh and now its value is rupees 2 lakh, the 1 lakh difference is nothing but the capital gain. And the same goes for equity and the mutual funds as well. A capital gain may be a short term, and for shares it is short term if it is for a period of 1 year or less, and long term if it is for a period of more than 1 year. Now income tax rates are separate for long term as well as short term capital gain. Earlier what happened that there was no tax on long term capital gain on sale of shares, but 15% tax was levied on the short term capital gains on sale of shares. Now let's understand this further through this pictorial representation. Now capital gains can be either short term or long term. Now in general, if the holding period of the asset is more than 36 months, it would be a long term capital gain, and if the holding period is less than 36 months, it would be a short term capital gain. However, there are certain exceptions, and in these exceptions equity is also covered. So let us look at these exceptions. Now for immovable property, this period is 24 months, and for listed shares and equity mutual funds, as we just discussed, the period is 12 months, and for other listed securities like debentures, bonds, etc., this period is again 12 months. Now what happened was, till now long-term capital gain tax on the equity shares and the equity mutual funds. So we have to remember here that equity shares and equity mutual funds was exempt from payment of taxes provided security transaction tax has been paid, and short-term capital gains on these was taxable at 15% provided securities transaction tax has been paid. The Finance Minister has recently announced that long-term capital gain tax which arises out of the sale of equity oriented mutual funds as well as from the direct sale of equity shares will be taxed at the rate of 10%. So suppose you buy equity shares in 2017 worth rupees 1 lakh, and in 2019 their worth is 2 lakh. You will be paying 10% tax on the capital gains, that is 1 lakh. So you will be paying 10,000 as your tax on capital gain. However, exemption has been provided for smaller capital gains, and it has been provided that no capital gains would be tax will be charged if the gains are less than rupees 1 lakh in a year. So if you are gaining less than 1 lakh, no tax would be charged on long-term gains. So this is the gist of the budgetary proposal. Now whenever a long-term capital gain occurs, that is you sell your equity shares or your units of equity mutual funds after a period of 12 months, and the amount exceeds rupees 1 lakh, you will be paying 10% tax. But if this amount does not exceed rupees 1 lakh, there won't be any tax. However, this security transaction tax will continue to be imposed. So let us also learn about these equity shares and the units of equity oriented mutual fund. Now equity shares are simply the shares which carry the voting rights and carry the profit sharing for their holders. But for the units of equity oriented mutual fund, these are those mutual funds in which 65% of the investment have been made in the equity shares of domestic companies. So this is about the units of equity oriented mutual funds. Now an important highlight of the amendment made by Honorable Finance Minister is this grandfathering provision. Now what is this grandfathering provision? Now it means that all your gains that have arisen up to 31st of January 2018 won't be taxed. Only the gains that arise after 31st of January 2018 would be considered. Let's understand this through an example. Now suppose you bought shares worth rupees 100 in November 2017. Now their price as on 31st of January 2018 is rupees 140, and you sell these in December 2018 for rupees 120. Now in this case it may seem that you have earned a gain of rupees 20, but this will be covered under the grandfathering provision, and the gains earned up to 31st of January 2018 won't be taxed. So your entire gain will become exempt. So your gain would be 0 or nil. Now if the selling price in December 2018 is rupees 160, now in this case you are earning even more than the price which was prevalent on the 31st of January 2018, that is rupees 20 more you are earning. So you will be paying tax only on rupees 20 and not on entire capital gain, that is rupees 60. So this is the grandfathering provision that has been provided in the Union Budget of 2018. A related amendment which was made is that the 10% dividend distribution tax is also going to be charged on mutual funds. Now to ensure that the investors who have put their money in the equity mutual fund scheme do not switch to dividend plans. Now they may feel that if they stick to the growth plan in which the capital appreciates, they may be charged capital gains tax. So they may try to evade that provision by switching to dividend plans in which regular dividend would be paid by the mutual fund. Now to cap this scenario, which would have been possible, a 10% capital gain tax has also been imposed on the dividend distributed by the equity mutual funds. Now whenever equity mutual fund would be distributing dividend, it would be deducting this 10% tax. Now in this case no exemption of rupees 1 lakh has been given. So even if you earn a dividend of rupees 10,000 from equity mutual fund, you will be charged this 10% capital gain tax. So this is a related development which has occurred, and it was necessary to make this development to make sure that the balance remains between equity dividend and equity growth mutual fund schemes. So this is the gist of the related amendment. So you can see here that now in both the growth mutual funds and in the dividend mutual funds there will be 10% tax. In growth mutual funds, investor would earn by appreciation of capital and they would earn by capital gain, so 10% tax would be imposed. And now on dividend mutual funds also, investors who earn by getting regular dividend will have to pay 10% tax. Now let us try to understand the justification and try to analyze the implications of this move by Honorable Finance Minister. Now from a macro point of view, it seems justified to impose this 10% tax on long-term capital gains. Why? Because the stock market investors were growing rich day by day and they did not pay any tax on their long-term capital gains. And this is why all the investors have been impacted over the past few days, be it foreign portfolio investors or be it retail investors. The stock markets suffered brief shocks on this announcement and has been on a downward trend over the past few days after this announcement. Now, an important thing that can emerge here is that disinvestment program of the government may get affected. Why? Because the government may not get a very high price for the shares it may be wanting to disinvest in future. So the disinvestment program may get affected a bit, but over the long term it seems that the markets would stabilize and the disinvestment program of the government would continue unabated without any hurdle. Now let's look at some of the MCQs based on the topic we just covered. Which of the following is incorrect regarding capital gains? It refers to an increase in the value of an capital asset. Capital gains may be short-term or long-term. Income tax rates are separate for long-term and short-term capital gain. All are correct. So in this case, all are correct. According to the budgetary proposal, 10% long-term capital gain tax is going to be imposed on the sale of equity shares or the units of equity oriented mutual funds, both A and B, or D, none of the above. So in this case the answer is C, as we have covered in the previous slides. What is the cutoff date as decided in the Union Budget 2018 with respect to the grandfathering provision in relation to the long-term capital gain on sale of shares and equity mutual fund units? So we have to find out the grandfathering date: 31st of January 2018, 1st February 2018, 31st March 2018, or none of the above. So the correct answer here is 31st Jan 2018. To ensure that the investor do not switch to dividend plans of mutual fund in order to escape paying the new capital gain tax, Budget 2018 has introduced dividend distribution tax of 5% for mutual funds, 7.5% for mutual fund, 10% or 15%. So this again has been covered by us. The answer is option number C, dividend distribution tax of 10%. So these are the answers. So guys, this was all about long-term capital gains tax on the shares in the Union Budget 2018. Thank you.